Okay, so students, we are going to start very first area of our syllabus, that is capital gains tax. Capital gains tax. Students, this tax is payable. First of all, please remember this tax relates to non-current asset. This tax will be applicable on sale of non-current assets. Capital gain tax will arise when few conditions are satisfied, starting with chargeable person. Whenever a chargeable person makes a disposal of chargeable assets and he has capital gain, he has realized capital gain on sale on these assets, he is going to pay tax on this gain, and that tax is called CGT, capital gains tax. Whenever a chargeable person makes a disposal of chargeable assets and realized capital gain, he is going to pay tax on this capital gain. That tax is called capital gains tax. Now, we are going to discuss these terms one by one. Who is chargeable person? What is the meaning of disposal? What are the types of chargeable assets? How to calculate capital gain? And then later on, we will discuss how to calculate tax. So in today's class, we will cover all these terms and we will end today's class on the calculation of capital gain tax liability. So our today's class will be based on these few points. Starting with the very first term, which is chargeable person. Students, there are two types of chargeable person for CGT perspective. One is UK resident. If a person is UK resident, he is going to pay tax in the UK on sale of his UK assets as well as overseas assets. If an individual is UK resident, he is going to pay tax on both of his assets, UK assets plus overseas assets. So a UK resident person will pay CGT in the UK on sale of UK assets and overseas assets. And one point is understood, obviously he's going to pay tax if he will realize profit. If he will earn profit, only then he will pay tax. We are not going to pay any tax on the losses. So if he's going to sell his UK assets or overseas assets and he's going to realize capital gain, only then he's going to pay tax. There is no tax on capital loss. On the other hand, if the person is not UK resident, non-UK resident, then all of his overseas assets are exempt. All of his UK assets are exempt. But there is an exception for UK assets. That is UK property. So if a person is not UK resident, he's not going to pay any tax on overseas assets. He's not going to pay any tax on UK assets except UK residential property. So UK residential property is taxable regardless of the status of an individual. The person who owns UK property, on disposal of that UK property, he is going to pay tax in the UK, either he is resident or not. So this was the very first term called chargeable person. So chargeable person can be UK resident or non-resident. Let's move towards the second term, which is disposal. So disposal means transfer of asset. So these are the examples of transfer of asset. So sale, gift, theft, lost or destroyed, and damaged. So in all these examples, asset has transferred. Now, the next term is date of disposal. So date of disposal. Normally the date when all the risk and rewards of an asset has transferred. The date when all the risk and rewards of an asset has transferred will be the date of disposal. So in normal contracts, date of disposal is basically the date of contract. On date of contract, all the risk and rewards of the asset has transferred to the other person, and that date will become the date of disposal. Date of contract is equal to date of disposal. But there are certain contracts in which conditions are attached. These are called contingent contracts. These contracts will become legally binding when all the conditions are satisfied. For example, let's say I'm saying that I'm going to sell a building, but if the profit of my business will be more than 2 million for the current year. So there is a condition that this contract will become legally binding if the profit for the current year will be more than 2 million. Only then I'm going to sell this building. Otherwise, this contract has no worth. This contract has no value. So we will wait for the year end. If the profit for the current year will be more than 2 million, then this contract will become legally binding and I'm going to sell this building. So in case of contingent contracts, the date when all the conditions are satisfied, date when all conditions satisfy will be the date of disposal. There is another case that is called death transfers. Students, in case of death transfers, CGT is not applicable. CGT is applicable whenever an individual will transfer an asset during his lifetime. So it is only applicable on transfer of asset during life. So if an individual has died, obviously the property or assets of that individual is going to be shared between his or her family members, at that point of time, CGT is not applicable. Please remember, CGT is a lifetime tax. It is applicable during life only. So for the deceased person, there is no CGT. But on death of an individual, obviously assets of this individual are going to be shared between his or her family members. Those are called beneficiaries or donees. So for the beneficiary, the cost will be market value at death. For example, the deceased person owns a car and that car has transferred to his son on his death. So the market value of this car on death date of this individual will become the cost for the son. So market value at death date will become the cost for the beneficiary. And market value at death date of an individual of an asset is called probate value. Probate value. So probate value is basically market value of an asset at death date of an individual. Disposal proceeds means selling price. What should be the selling price of an asset sold? Starting with sale at market value. If we have sold an asset at market value, then obviously there is no issue at all. Disposal proceed will be the selling price we have received because we have sold the asset at market value. Secondly, in case of gifts or sale at undervalue, in case of gifts or sale at undervalue, in both these cases, disposal proceeds will be market value. If, for example, if the market value of an asset is say 10,000 and we have sold that asset for 8,000 pounds, so as per the tax law, this is your own choice. You can sell an asset at zero value, but from tax perspective, selling price will be the market value. You will deduct your cost from the market value. That would be the capital gain, and you are going to pay tax on that capital gain. From tax point of view, they will take market value as a selling price. Third one, there are few special rules. There are few special rules for asset lost or destroyed or theft. In these cases, we need to consider insurance proceeds. So that's why these cases will be covered later on in our syllabus. Right now, I'm skipping these points. So there are special topics, there are special rules for asset lost or destroyed or theft or damaged. In all these cases, we need to consider either we are going to receive any insurance proceeds or not. So we need to consider insurance proceed. And in the last case, we are going to discuss transfer between spouse. If there is a transaction between husband and wife. So students, in this case, DP stand for disposal proceeds. So if there is a transaction between husband and wife, in these cases, disposal proceed will be equal to cost. So it means there will be no gain. If we have sold an asset at cost, obviously there will be no gain, no loss. In these cases, we are going to ignore actual selling price of the asset. For example, husband sold a plant to wife. Selling price is 5,000. Selling price is say 6,000. Market value is 10,000 and cost of the asset is 3,000. So this is a small example. So because this is a transaction between husband and wife, so in this case, disposal proceed will be cost. So what is the cost of the asset? 3,000. What was the cost? 3,000. So in fact, it will be assumed that husband has sold this asset to wife at cost. So there will be no gain, no loss. So in your exam, whenever you will see a transaction between husband and wife, you are simply going to write down, this is a transaction between spouse, so no gain, no loss. You don't need to calculate anything. And for the wife, what should be the cost of this asset? Selling price of the husband will obviously become the cost for the wife. Selling price for the one party will become the cost for the other party. So if for the seller, this is the selling price, obviously it will be the cost for the wife. Whenever wife will sell this asset in the future, wife will take 3,000 pounds as a cost and market value and actual selling price will be ignored. Finally, there is an exception. This rule is not applicable for death transfers. Suppose if husband has died and he has transferred his asset to wife on death, in that case, cost will be probate value. Okay, so normally if there is a transaction between husband and wife during the lifetime, then cost of one person will become the cost of the other person. So you can see 3,000 was the cost of the husband and same 3,000 will become the cost for the wife. So all the transactions between husband and wife are recorded at cost, but this rule is not applicable in case of death transfers. If an asset has transferred on death of an individual to the other parties in the spouse, in that case, for the person, for the party who is in the spouse who is receiving the gift, in that case, probate value will become the cost of the asset. Okay, moving forward. So this was all about disposal proceeds. Students, if you have any question, you can ask. So right now we have covered first two terms. First one is chargeable person and second one is disposal. We have covered multiple points related to disposal assets. Chargeable assets. Students, all assets except exempt assets. Tax law has provided a list of assets on which capital gain tax is not applicable. So you just need to memorize that list. And exempt means tax is not applicable, CGT is not applicable on these assets. So all assets except exempt assets are called chargeable assets. So what are the exempt assets on which CGT is not applicable? Starting with cars. All type of cars are exempt from CGT. CGT is not applicable on cars. Secondly, all type of current assets. All the current assets are exempt in the CGT. Okay, so as you all know, the different examples of the current assets: cash, receivables, inventory. So these are the examples of current assets. Third one is debts. Students, all type of debts are exempt in CGT. So for example, maybe loan notes, maybe debentures, maybe certificates, maybe bonds. So all the types of debts are exempt in CGT. Next one, ISA. ISA is basically a bank account, individual saving account, and any returns received from this account is exempt from CGT. So for example, if you have deposited your money in this account, if you have deposited your money in this bank account, and obviously bank is going to invest your money in non-current assets, and bank is going to give you a share on disposal of those assets. So any return, in simple words, whenever the word ISA will be used, any return received from this ISA account will be exempt. Next one. Okay, so next one is prize or betting winning. So these are exempt in capital gains tax. And the next one is sum chattels. So what are chattels? Chattels is basically tangible movable assets. Tangible movable assets are called chattels. Few chattels are exempt and few chattels are taxable. There is a complete topic on chattels. We will cover the chattels in detail when we move towards this topic. So few chattels are exempt and few are taxable. So these are the examples of exempt assets. You should memorize this list, and all the assets mentioned in this list are exempt. And we are going to pay capital gains tax if we are going to sell any asset other than these few assets. All assets are chargeable assets except these few exempt assets. So whenever a chargeable person makes a disposal of chargeable assets and realized capital gain. Now let's move towards capital gain. How to calculate capital gain? Friends, for example, I have purchased a building. I have purchased a building for £100,000. At the time of the purchase of this building, I have incurred incidental cost. Incidental cost means any additional cost at the time of purchase or sale. So at the time of the purchase of this building, I have incurred few extra costs. For example, maybe marketing cost, maybe property agent fee, maybe legal documentation cost, maybe auctioneer fee. So there are multiple extra costs which need to be paid other than the purchase price. So for example, I have paid £5,000 as an incidental cost. Later on, I have constructed a new room on this building. So it means there are capital improvements. So only capital improvements will be considered over here. Suppose I have constructed a new room and I have incurred expenditure of £15,000. So the total cost of this building is £120,000. Now I'm going to sell this building and say I have sold this building for £200,000, and similarly there may be incidental cost at the time of disposal. So similarly, just like purchase, maybe I need to incur marketing cost, I need to pay commission to the agent. So there are incidental cost at the time of disposal. Can you please calculate gain or loss for me? So there is a capital gain of £70,000. So this is the detailed items which you can see in the calculation of capital gain or loss. In the exam, most of the time you will see selling price and purchase price. So we have sold asset 1 and we have capital gain of £70,000 from disposal of this asset. Suppose we have sold another asset, asset 2. Disposal proceeds. We have sold this asset for £60,000. Cost of this asset was £20,000, sorry, £80,000. And we have capital loss of £20,000 from asset number 2. So students, in this way, we will calculate gain or loss for every single asset in the working. And then later on, we will prepare the performer for all these assets. So just like I have calculated gain for the asset number 1 and I have sold another asset, I have calculated loss for this asset, and then we will move towards CGT performer. The next topic is capital gains tax pro forma. First of all, we will write down the name. For example, if we are calculating tax for Mr. A, then Mr. A capital gain tax computation, and right now examinable tax year for us is 2021. Our examinable tax year is 2021 and started on 6th April 20 and it will end on 5th April 2021. During the year, we have sold two assets. Asset number one, we have capital gain of 70,000 pounds, and we have sold another asset, asset two, and there is capital loss of 20,000 pounds. It is called net chargeable gain. So in this way, we will calculate gains and losses for all of the assets, and then in the main pro forma, in the capital gain tax pro forma, we will net off these gains and losses. We have net chargeable gain of 50,000 pounds. If loss over here, if there is net loss over here, if net loss, then no CGT. And close pro forma over here. So if we have net loss, obviously we are only going to pay tax on capital gain. If we have net loss over here, we are just going to close this pro forma over here and there will be no CGT. But right now we have net gain of 50,000 pounds. Over here we will deduct annual exempt amount. So what is annual exempt amount? This is basically a fixed relaxation available to every individual every year. And the amount is 11,300. Please remember, if we have loss over here, if we have loss over here, if net loss, then annual exempt amount will be wasted. If we have loss over here, we will close our pro forma over here, and this annual exempt amount will be wasted. We cannot utilize this annual exempt amount in the next year or anywhere else. Simply it will be wasted. Secondly, if net chargeable gain is less than annual exempt amount, so annual exempt amount will be restricted to gain. Restricted to gain. So if we have loss over here, simply we are going to waste annual exempt amount. On the other hand, for example, if we have gain of instead of 50,000, suppose if we have gain of 7,000 over here, so we are not going to claim full annual exemption of 11,300. We are just going to claim annual exempt amount of 7,000, and remaining annual exempt amount will be wasted. Okay. So please remember these 2 points. Yes, it is 12,300. Sorry, my bad. It is 12,300. So the fixed amount of the annual exemption or annual exempt amount is 12,300. Now, can you please tell me the answer over here? 50,000 minus 12,300. It should be 37,700 if I'm not wrong. It is called taxable gain. If we have any brought forward losses, we are going to deduct them over here. Brought forward capital loss. Please remember, first you need to deduct annual exempt amount. If you have remaining gains, only then you can deduct your brought forward capital losses over here. So suppose we don't have any brought forward capital losses. So our taxable gain is 37,700. Students, if you have any issue in this capital gain tax pro forma, you can ask. Simply, we will net off gains and losses of all of the assets. We will deduct a fixed relaxation of 12,300. Later on, we will deduct any brought forward capital losses, and then answer is taxable gain. On this gain, we are going to pay tax. And there are two rates of tax. On unused basic rate band, I will explain this point in a while. Unused basic rate band, tax rate will be 10%, and on remaining gains, tax rate will be 20%. And this will be our CGT liability. So now What is unused basic rate band? Let's move towards the next point. Basic rate band. Basic rate band is basically a lower level for both income and capital gain where rate of tax is lower. Basic rate band is a level of tax, and this is a combined level for both income tax and CGT where rate of tax is lower. And it amount for the basic rate band is fixed at 37,500. But please remember, this level is a combined level for both income tax and capital gains tax. For example, let's start with the term taxable income, and we will discuss these points in detail one by one. So how to calculate taxable income? Simply, we will add all incomes of an individual less personal allowance. So what is personal allowance? Just like capital gains tax, you can see over here there is a fixed relaxation available in the capital gains tax, which is called annual exempt amount. In the same way, there is a fixed relaxation available in the income tax that is called personal allowance. And amount is fixed at 12,500. In this way, you will be able to calculate taxable income. Now, suppose your taxable income is 20,000 and amount of the basic rate band is 37,500. It means you have consumed 20,000 pounds out of the basic rate band in the income tax, and remaining amount will be used in capital gains tax. Basic rate band. Amount of the basic rate band is fixed at 37,500. Suppose your taxable income is 20,000, so it means you have consumed 20,000 of the basic rate band in the income tax, and remaining amount is 17,500. This is basically unused basic rate band. So when we will calculate capital gains tax, we have taxable gains of 37,700. We will apply 10% tax on 17,500. Out of 37,700, which is our taxable gain, we will apply 17,500 at the rate of 10%. And on remaining gain, we will apply 20% tax. Okay, so we need to think about income tax first. Either we have consumed the basic rate band in the income tax or it is unused from the income tax. So if the basic rate band is not fully utilized in the income tax, only then we can use the remaining amount of the basic rate band in the capital gains tax. For example, our basic rate band will remain fixed at 37,500 and taxable income is 0. In that case, 37,500 is the amount of unused basic rate band, and we will use this unused basic rate band in the capital gains tax. In the same way, suppose our taxable income is 60,000. So our taxable income is 60,000 while basic rate band is fixed at 37,500. It means we have fully consumed the basic rate band in the income tax. And we are going to pay 20% tax on full gain because basic rate band has fully consumed in the income tax. For example, Mr. A sold following assets in 2020-21. Mr. A sold asset 1 and he has capital gains. Straight away I'm giving you the information of capital gains. And on asset 2 we have capital loss of 7,000 pounds. We have sold asset 3 and we have gains of 3,000 pounds on asset 3. Regarding the income, this individual has rental income of 30,000 pounds and interest income of say 5,000 pounds. Requirement is we need to calculate capital gain tax liability. So we are starting with Mr. A CGT computation. For the tax year 2021, this individual has sold 3 assets. So first of all, we will net off gains and losses of these 3 assets. On asset 1, we have gain of 40,000 pounds. On asset 2, we have loss of 7,000 pounds. And on asset 3, we have gain of 3,000 pounds. So 36,000 if I'm not wrong. Net chargeable gain is 36,000. Over here we will deduct annual exempt amount, which is 12,300. Then I will deduct brought forward capital loss, which is 0. I have taxable gains. Can you please tell me the amount over here? 23,700. Now we are going to pay tax on 23,700. Before we move towards tax rates, we need unused basic rate band. So this is working number 1 for basic rate band. We will start with taxable income. In order to calculate taxable income, we need to add all of the income of this individual. This individual has rental income, of £30,000 and interest income of £5,000, means £35,000 in total, less personal allowance, 12,500. Answer is 23,500 if I'm not wrong. 22,500. This is taxable income. Now, unused basic rate band. Total basic rate band is 37,500. We will deduct 22,500 because 22,500 is used in the income tax. So the remaining amount is, can you please tell me? Basic rate band is unused by 15,000. So in the CGT, we will apply lower rate on 15,000 and higher rate on remaining gains. So our total gains are 23,700 on 15,000 coming from working number 1. We will apply 10% tax and remaining 8,700 we will apply higher rate of tax, which is 20%. Over here 1,500 and then 8,700 into 20%. 17,1740. So 3,240 is the total tax. So this is a complete example on the calculation of capital gain tax liability. In case of gains of residential property, we will apply 18% tax instead of 10%, and we will apply 28% tax instead of 20%. So the rate of tax is 8% higher in case of residential property. So let's understand this concept with the help of an example. In 2020-21, Mr. A has falling gains. He has sold residential property and capital gains are, suppose, 30,000 from the residential property. He has other gains of £50,000. There are few brought forward capital losses of say 4,000. And now we are going to solve this example. Mr. A, capital gain tax computation for the tax year 2021. Whenever gains are given for the residential property, friends, we will prepare two columns. We need to keep both types of gains separate because tax rates are different for every type of gain. So we will prepare a separate column for the residential property and we will prepare a separate column for the other gains. From the residential property, we have capital gains of £30,000, while other gains are £50,000. There is no loss in the current year. So these are our net chargeable gains. Now we will deduct annual exempt amount. Students, what's your opinion? What do you say? Either I should deduct the annual exempt amount from the gain of residential property or the other gains. What do you think? What should be the first priority? So I should deduct annual exempt amount from residential property first, and if these gains are insufficient, then remaining amount can be deducted from other gains. But first priority should be residential property. Obviously, rate of tax is higher in residential property. In the same way, brought forward capital losses will be deducted from the gain of residential property, which is 4,000, and same is the logic. These are our taxable gains. Please tell me the amount. $13,700. Okay. Now we are going to calculate tax. Suppose income of this individual is 0. If the income of this individual is 0, it means 100% basic rate band is unused. When applying the tax rate, first of all, we will apply tax rates on the residential property. On 13,700, we will apply a tax rate of 18%. So we are done with gain of residential property. Now we will move towards gain of other than residential property. But what is the remaining amount of basic rate band? In the current year, we don't have any income, so 37,500 was the amount of unused basic rate band. So we have consumed 13,700. We have applied lower rate on capital gains of 13,700. So the remaining amount of the basic rate band is 23,800. So when we will move towards other gains, which are 50,000, in total. So out of these 50,000, we will apply lower rate of tax on 23,800. Lower rate of tax on the other gains are 10%, and on remaining gains, can you please tell me the difference? 23,800 minus 50,000. 26,200. Okay. So now over here we have fully consumed the basic rate band. So on remaining gains, we will apply higher rate of tax. Please tell me the amounts of taxes. It's 13,700 into 18%, 2466. Okay. So then what is the amount of tax? CGT liability? 10086. Okay. So this was all about gain of residential property. Next one is capital loss. So students, we have already covered capital losses. We have already discussed the treatment of capital losses. Current year capital loss will be deducted from current year capital gains. Will be deducted from current year capital gain. While brought forward capital losses can be carried forward indefinitely and deducted from capital gains after annual exempt amount of future years. So this is basically the treatment of capital loss. Current year capital loss will be deducted from current year capital gains, while any unused capital losses will become brought forward capital loss in the next year. So any brought forward capital losses can be carried forward indefinitely and deducted from capital gains of future years, but in the future years, you will deduct your brought forward losses from capital gains which remains after deduction of annual exempt amount. There are a few other points related to capital losses. One is death year capital loss. Death year capital loss. Students, as we have discussed earlier, that CGT is a lifetime tax and CGT is not applicable after the death date of an individual. And now I'm saying death year capital loss. If CGT is not applicable after death date of an individual, it means we are not going to calculate any capital gain or losses. So what is the meaning of this statement then? Death year capital loss. Students, death year capital loss means Our current tax year is from 6th April 2020 and it will end on 5th April 2021. So this is our current tax year. And an individual died on 31st of December 2020. So this is basically death date of the individual. There will be no CGT on asset transferred after this date. Because CGT is a lifetime tax, it is not applicable on transfer of assets after the death date of an individual. But what about this duration? CGT is applicable on assets sold during this time. So if there is net gain on disposal of assets during this time, obviously he's going to pay tax on this capital gain. But if there is net loss during this time, this individual has sold 2-3 assets, we have calculated their gains and losses, and there is net loss during this time. Net capital loss. This loss is called death year capital loss. Death year capital loss. Now, what is the treatment of this death year capital loss? Students, death tax year of this individual is 2021. So what are the previous 3 tax years? Previous tax year will be 1920, then 1819, and then 1718. So these are the previous 3 tax years. Death year capital loss death year capital loss will be deducted death year capital loss will be deducted from capital gains of previous 3 tax years on LIFO basis. Means this loss will be deducted first of all from 1920. So gain of the 1920 will be reduced and you will receive refund from HMRC. Then if gain is insufficient to cover this loss, remaining loss will be deducted from 1819 and then remaining loss will be deducted from 1718. This is called LIFO basis. Noman, yes, if there is net gain during this time, we can say it is net chargeable gain or death year capital gain. But please be careful, it should be the gain before date of death. If the assets are transferred after the death date of an individual, we cannot calculate gain on those assets. That gain cannot be considered as death year capital gain. So this was all about death year capital loss. Any question? The last point is negligible value claim. So what is negligible value claim? If value of an asset becomes negligible means zero. So if the value of an asset becomes negligible, and that reduction in value is not expected, then negligible value claim is available. If value of an asset becomes negligible, means becomes zero, and that reduction in value is not expected. It means it should not be a depreciating asset. Normally, in case of depreciating assets, the reduction in the value of an asset is expected. So with the passage of every year, the value, we will use this asset and the value will be reduced over the years. So in case of depreciating assets, the reduction in value of an asset is expected. In that case, negligible value claim is not available. So negligible value claim is only available for those assets whose decrease in value is not expected, and there is unexpected decrease and the value of the asset becomes zero. For example, if the value of an asset has reduced from 10,000 to 7,000 and that is unexpected decrease, negligible value claim is not available. So value must be reduced to zero or almost zero. The best example for these type of assets is shares. You never know either the price of the shares is going to increase or decrease. It totally depends upon the market. So for example, Mr. A has purchased shares of a company and cost of these shares is say 9,000, and company went into liquidation. Company becomes bankrupt. Company went into liquidation or bankrupt. You can check the spellings. So due to bankruptcy, the value of these shares, market value of shares becomes zero. Now you can claim negligible value claim. So you have purchased the asset for 9,000 pounds. Now the shares have worth zero, or say 100 pounds. And it is mentioned in the question that it is negligible. So if there is minor value for this asset, then it will be mentioned in the exam that it is negligible. But most of the time, value will be reduced to zero. Now, first of all, let's calculate capital loss. What is the amount of capital loss? The asset which was purchased for 9,000 pounds have worth 100 pounds. So can you please calculate the capital loss? 9,000 minus 100 pounds. So it is 8,900 pounds. there is a capital loss of £8,900 and there is normal treatment of capital loss. It will be treated just like normal capital loss. It will be deducted from capital gain of current year and any remaining loss will be carried forward and deducted from capital gains of future years. And now, what is the revised cost of the share? Revised cost of shares, £100, because currently these shares are worth £100. So whenever we are going to sell these shares in the future, cost will be considered as £100 because we have already claimed the remaining amount of capital loss. But please remember, this claim is only available when the value of an asset has reduced to 0. Students, is there any question? Capital gain tax will arise when a chargeable person, we have covered this term chargeable person, makes a disposal. We have covered all of the relevant points of disposal of chargeable assets. So we have already covered what are exempt assets and what are chargeable assets. And there is a capital gain. So we have already covered what is capital gain and how we are going to calculate it and what is the treatment of capital loss. And we have already learned how to calculate tax.